Welcome back to the Deep Dive. Today we are cutting through the noise to analyze, well, one of the most critical and, frankly, highly valued companies in global infrastructure. Prologis, Inc., ticker PLD.
Right. And this isn't a company that just owns some sheds. We're talking about the owner of the most important intersections of global trade.
The undisputed hegemon of industrial real estate. I think they even call themselves the sovereign of the supply chain.
They do. And for you, the critical investor listening, our mission today isn't to debate if the assets are good. I mean, that's a given. They're pristine.
So what is the mission?
Our mission is to take the measure of Prologis's competitive moat and determine with, forensic rigor if that advantage is really robust enough to justify the massive valuation premium the market is giving it.
Especially now, in this completely new macroeconomic world.
Exactly.
Okay, let's unpack that. For the better part of a decade, up until maybe 2022, the thesis for PLD was, well, it was simple. Dead simple. You had this endless runway of e-commerce growth.
Yeah.
And you paired that with near zero capital costs.
It was the perfect investment cocktail. It justified, almost any gross estimate you could throw at it.
But those days are over.
They are gone. We are now navigating what we're calling the regime of normalization.
The regime of normalization.
Right. All the algorithms, the whole philosophy of growth, at any cost that defined the 2010s, it's fundamentally broken because the cost of capital has surged. We're in an environment now where borrowing costs are inverted against acquisition yields. The cost of your debt is actually higher than the return on the asset you're buying.
Which means buying things is value destructive.
Immediately, from day one.
So Prologis is at a major inflection point. And our objective today is to really stress test their operations, their valuation, everything.
And we're going to do that by synthesizing their huge global scale with some very granular, very focused data.
We're looking at pure play peers like Rexford Industrial, REXR, to get a really unvarnished view of what market stress looks like.
And we're also using the operational realities of their biggest tenants, someone like XPO, Inc., as our proxy for demand. How healthy is it really?
Which brings us to the core conflict, the central question of this deep dive.
Why is the market willing to pay around 22 times price to funds from operations for Prologis?
Which is a huge premium.
It's a significant 5-turn multiple premium compared to a high-quality peer like Rexford, which is trading closer to 17 times.
So does that premium offer you any real margin of safety? Or is it just pricing for absolute perfection?
That's the question.
So the initial thesis we have to confront is that Prologis is no longer this hyper-growth vehicle. The easy acquisition model is dead.
Right. It's more of a compounder in transition.
A compounder in transition. And what does that mean for returns?
It means future returns, if the case holds, hinge entirely on management's discipline, on their capital allocation, and on strategically harvesting the rent growth that's already embedded in their leases.
Not just growing the asset base for the sake of growth.
Exactly. So we need to figure out if their undeniably durable moat protects their valuation, or if that rich valuation is blinding the market to some very real, very localized cyclical risks.
Okay, let's start the stress test. To do that, we have to look squarely at the macro environment. Industrial real estate, at its core, its demand is entirely derived demand. It's tied directly to the physical velocity of goods moving through the supply chain.
And right now, that velocity is slowing down significantly.
This is the soft freight environment we've been hearing about.
Or the freight recession, yeah. We saw it start in 2023, and it's continued right through 2025. It's a classic, if, painful reversal of that pandemic-era panic.
Oh, I remember the frenzy of 2021, 2022. Every company was terrified of stockouts.
Right. And they all shifted to this just-in-case mentality.
They overordered everything. They were scrambling for any space they could find, which is what squeezed vacancy down to, historic lows.
It's a textbook bullwhip effect. Small changes in consumer demand at the retail level get amplified all the way up the supply chain,
leading to massive overordering by manufacturers, by distributors, everyone.
And now, the second half of that bullwhip is snapping back. Hard.
Supply chains are unclogging, consumer demand is normalizing.
And critically, companies are now aggressively rationalizing all that excess inventory they built up.
And we've got hard data on this, right? It's impacting Prologis' tenants.
We do. A company like XPO, a major logistics operator, very representative of PLD's customer base, reported a pretty substantial tonnage decrease.
Tonnage?
6.7% year over year in the second quarter of 2025.
Almost 7%. That's not a small number.
No. And That data point is crucial. It gives us a direct insight into the demand side.
When actual freight volume contracts by that much, the urgency to expand just evaporates.
Overnight, that fear of missing out on space, the psychological labor that landlords use so effectively, it's gone.
And it's been replaced by what?
By highly calculated, cost-conscious planning. Companies aren't looking for new facilities. They're trying to optimize the ones they already have.
But this leads to a really fascinating counterpoint, something that suggests the biggest tenants are actually getting smarter.
Yes.
Despite that drop in tonnage, that lower volume, the sophisticated tenants are getting financially healthier.
They are. They're aggressively implementing what you'd call a price over volume strategy.
And what does that mean in practice?
It's a vital nuance. It separates the winners from the losers. The XPO data confirms it. Even with that 6.7% tonnage decline, they grew their yield, their pricing, their profitability by 6.1%.
So they didn't chase unprofitable freight.
No, they focused on moving high-margin volume. They got disciplined.
So if the big tenants are focused on optimization and profitability, what's the direct implication for Prologis' portfolio, for their future leasing?
It means the bifurcation in demand just accelerates.
Okay.
The shift is decisively towards modern, high-efficiency buildings, the ones with superior clear heights, optimized bay depths, advanced cross-docking, deep truck courts.
All the stuff you need for automation and rapid turnaround.
Exactly. Those are the facilities that actually enable cost savings. So this whole situation just accelerates the flight to quality.
And what happens to the older, less functional assets?
They face disproportionate and rapidly increasing vacancy risk. So this actually structurally favors Prologis' modern high-spec portfolio.
Now we have to talk about the death of the core narrative that fueled these multiples for years. The e-commerce sugar rush is fading.
For years, this whole sector was sold as a secular growth story.
An infinite runway that justified any valuation.
And that narrative is now just slamming into the harsh reality of a cyclical normalization.
So we have to adjust our framework.
We must. Industrial real estate is moving from being a secular growth asset class.
Where you just assumed, what, 50, 60, 80% rent hikes on renewal forever?
Pretty much. And it's moving to a cyclical growth class. It's driven by economic cycles now, not some permanent tech-driven shift. That initial explosion from e-commerce penetration is just, it's exhausted.
And the immediate painful consequence of that is what you call price discovery.
Right. Landlords have lost that immense negotiating leverage. And market rents, especially in the high-density areas that were the epicenter of the boom, are now showing some painful sequential declines.
And we've got hard data on this from Rexford.
The data is alarming, and it needs deep scrutiny. We look at Rexar because its 100% concentration in Southern California gives us the cleanest view of market stress.
And what did they report?
RXR reported that market rents in their portfolio were down approximately 12.8% year over year in Q2 2025.
12.8%. In the world's most supply-constrained market. That's not normalization. That's a deflationary correction.
It is.
So what's the precise consequence of that for Prologis' long-term FFO growth?
It all comes down to the erosion of the embedded growth, or the mark-to-market wedge.
Explain that.
For years, that spread between low in-place rents on old leases and the much higher current market rents, that was the engine of REIT growth. It was predictable. It was guaranteed.
Millions of dollars in future rent hikes just sitting on the books.
Exactly. But if market rents fall fast enough, if we see another year with a 12.8% drop, that embedded wedge just compresses dramatically. It could even go to zero.
And if that wedge compresses, the growth engine stalls, which completely undermines the justification for that 22 times multiple.
Precisely. You're talking about the risk of going from guaranteed 10% FFO growth to maybe 3% growth overnight.
And in the worst case.
In the worst case, if this deflation spreads across global gateway markets, you have to prepare for negative cash mark-to-market.
Meaning you renew a lease for less than the tenant was paying before.
Yes. That is the complete antithesis of the secular growth story, and it's the primary cyclical risk that the valuation premium does not seem to be adequately discounting.
Okay, despite that cyclical pain, there are real structural tailwinds here. This isn't the office sector.
No, it's not. The long-term drivers are robust, and they favor size.
Let's talk about consolidation and nearshoring.
The trend toward nearshoring manufacturing, driven by geopolitics and supply chain resilience, favors Prologis' huge global footprint.
And demand is changing. It's not just bulk storage anymore.
Right. It's evolving towards these complex industrial campus models, large integrated nodes that support light assembly, customization, all of that.
And the freight recession, ironically, seems to have accelerated the health of the survivors. The bankruptcy of Yellow Corporation was a huge moment.
Pivotal. It took out a huge chunk of LTL, or less than truckload capacity.
Forcing a flight to quality.
It did. And the well-capitalized players like XPO immediately capitalized. They bought 28 of Yellow's strategic service centers for $870 million. Irreplaceable assets.
So for Prologis, this consolidation is what you call a double-edged sword.
A powerful one that you, the investor, have to understand.
Let's start with the bull case, the upside of consolidation.
The upside is credit quality. The rent checks PLD receives now come from larger, more stable, often investment-grade companies, the Amazons, the Walmarts, the XPOs.
It's a huge buffer against recessionary defaults. The counterparty risk gets way better.
Dramatically better.
But the bear case? The bear case is negotiating leverage.
Exactly. If XPO is leasing 5 million square feet from Prologis across 20 different global markets, they walk into that renewal discussion with immense power.
Power that a small local company just doesn't have.
Right. So while consolidation minimizes your credit risk, it maximizes your leverage risk. A huge tenant can threaten to move their whole global portfolio to a competitor. That fundamentally caps the upside Prologis can extract.
Okay, we've established the complex external environment. Now let's get to the core of that premium valuation, the moat. Is Prologis' scale a true structural advantage that warrants 22 times FFO? Or is it just impressive empire building with low returns?
The advantage is, without a doubt, structural and enduring. It's built on two main pillars, the network effect and the cost of capital.
Let's start with the network.
Their primary edge is the ability to offer a seamless network product. A regional player like Rexford can sell you a great warehouse in LA.
Right.
Prologis can offer a global manufacturer a single master lease that covers LA, Rotterdam, Tokyo, and New Jersey.
Which is a massive administrative and strategic efficiency gain. It's impossible for a regional player to replicate that.
Impossible. It turns Prologis into a strategic partner, not just a landlord.
And that's the key accounts moat.
Precisely. By servicing these huge logistics majors, Prologis gets counter-cyclical resilience. These large-cap tenants, they use downturns like this one to invest more deeply in prime logistics, to optimize their network for the long term.
Their decisions are strategic, not reactionary.
Exactly. This provides a stability that smaller landlords who cater to SMEs can only dream of.
And tied directly into that network is the data. Their data supremacy.
If you own the world's logistics infrastructure, you have a proprietary data set on global trade flows that, frankly, rivals the logistics companies themselves.
Maybe even the World Bank.
Arguably. And that data is their true, unquantified capital allocation edge. They have intelligence on lease rates, utilization, freight flows, supply bottlenecks.
Which lets them predict demand shifts way earlier than competitors.
Far early.
So this is how they de-risk their development pipeline. They know where to build before the public signals even appear.
Exactly right. Their development, which is their highest return activity, is inherently less risky than a competitor who's just relying on backward-looking broker reports. They're making preemptive strikes based on proprietary intelligence.
Now, here's where it gets really interesting for, a sophisticated investor. The existential cost of capital advantage. Real estate is a spread business.
Yeah.
You borrow at X, you invest at X plus Y. In the old 0% world, that spread was tiny for everyone. Everyone had cheap money.
But in this new regime of normalization, with interest rates at 5% or higher, Prologis' A-rated balance sheet isn't just an advantage. It's a functional monopoly over value creation.
Okay, explain that.
When the marginal cost of debt for a smaller, more leveraged operator has jumped to 5.5% or 6%, and the cap rates on core assets are still stuck around 4.5 to 5%.
They're dealing with negative leverage. They lose money on day one just by borrowing the money to buy the asset.
Yeah. Correct. The acquisition is immediately value destructive, so the universe of buyers just shrinks dramatically. Those smaller peers, they have to stop developing and play defense. They have to sell assets.
Whereas Prologis preserves that spread, which lets them play offense.
Exactly. That A-rated balance sheet is the single strongest firewall they have. It positions them to acquire distressed assets at huge discounts while their competitors are forced sellers.
So it's not just a financial advantage, it's a strategic weapon.
It's the ultimate moat. Their borrowing cost dictates who survives this high-rate world. No amount of local market expertise can overcome the physics of negative leverage. Prologis can borrow cheaper than their competitors can invest.
Let's do a quick stress test on that. The big box versus infill dichotomy. PLD has a balanced portfolio. A peer like Rexford is 100% Southern California infill.
Right.
What's the vulnerability of that infill model now?
The infill model was prized for its supply and elasticity. You can't build a new warehouse in Venice Beach. Sure. But the vulnerability is in the tenant base. Rexford caters heavily to small to medium enterprises, SMEs,
Who operate on tighter margins.
and lack the balance sheet strength of a multinational. They are far more vulnerable to a freight recession, to inflation, and now to regulatory costs.
Whereas Prologis' big box model caters to investment-grade multinationals. The credit buffer.
Exactly. While those big box markets are more susceptible to supply overshoots, the credit quality of the tenants acts as a huge insulator against defaults. That diversification is a core part of the PLD moat.
But let's challenge that. Even the strongest moat has limits. The SoCal data shows that geographic barriers don't matter if the economics of the location start working for the tenant.
That is the essential, critical caveat. The moat protects Prologis against competitors, it restricts new supply, but it does not protect them against structural economic friction or regulatory risk. If drayage costs, labor costs, or new regulations push the total occupancy cost above what the tenant can afford, the scarcity of the land becomes completely irrelevant.
So demand destruction trumps supply inelasticity every single time. That's a key risk the premium multiple might be ignoring.
We need to spend some real time on Southern California. It's not just a market, it's the canary in the coal mine for the entire coastal industrial sector.
What happens there gets exported.
What happens there structurally and economically tends to become a policy export to other major gateway markets. Think Seattle, New Jersey, London, core PLD markets.
Let's start with the core financial risk. The rapid erosion of that mark-to-market growth, that 12.8% year-over-year decline in market rents from the Rexar data needs to be fully dissected.
That data point is fundamentally altering the historical earnings algorithm of this whole sector. Industrial wheat growth used to rely on a simple formula: high mark-to-market spreads plus some occupancy growth.
When market rents were always rising, that spread gave you 50, 60, even 80% rent increases on renewal. Yeah. That's what fueled the multiples.
It did. But with market rents now falling by nearly 13% in gateway markets, that spread is rapidly compressing,
forcing management teams to reset expectations.
They have to. They are now preparing for a potential scenario of negative cash mark-to-market.
So a lease signed in 2018 for $1 per square foot, when it expires today, instead of getting a 30% increase, you might have to renew at 90 cents.
That's the risk. You're renewing at a loss on the cash flow. That possibility puts a hard cap on FFO growth across the whole sector.
And this leads directly into the regulatory risk, which is a second structural headwind.
A regulatory pincer movement in Los Angeles that threatens to impair asset values globally if it gets exported.
First up is Measure ULA, the mansion tax.
Right. It introduced a 4% to 5.5% transfer tax on all commercial property sales over $5 million in LA.
The immediate implication.
It has seized up the transaction market. No one wants to buy an asset that instantly loses 5.5% of its value unless they get a huge discount.
So how does that hurt Prologis specifically? They're long-term holders.
They are, but they rely heavily on capital recycling. They sell older, stabilized assets to fund their high-return development pipeline. This tax directly lowers the exit value of those assets. It taxes their ability to monetize their portfolio efficiently.
Okay, and the second regulation is even more insidious, the WARE program, the tax on truck trips.
This one is a direct tax on the utility of the warehouse itself. It goes back to that occupancy cost cap.
The tenant has a max budget for using that property.
Exactly. A budget for rent, taxes, labor, operations. If that tenant now has to spend a huge amount on WARE compliance, buying cleaner trucks, or paying taxes on trips, that is a dollar that cannot go to rent.
So WARE acts as a regulatory ceiling on how high rents can ever go, no matter how tight supply is.
That's it. It reallocates economic value from the landlord to environmental compliance. And that's why we have to treat it as a potential policy export. What happens if this spreads to the Port of Newark?
But you mentioned a nuance here. Could this headache actually become an advantage for Prologis?
Paradoxically, yes. The costs of compliance installing massive EV charging infrastructure, solar arrays, that requires huge upfront capital.
Which smaller landlords don't have.
They don't have the balance sheet. Prologis, with its A rating, can absorb that capex. They can make their facilities instantly compliant, which makes them more valuable to big tenants who demand regulatory safety. They're essentially selling regulatory safety as an amenity.
Finally, let's talk about the simple supply glut, the pricing gravity well, the Inland Empire.
The IE east of LA. the high-volume big box market. Vacancy there has surged to near 8% because of speculative projects started at the peak of the euphoria.
And the IE acts as the relief valve for all of Southern California.
It does. And the supply glut there is forcing aggressive price cutting. When big box prices drop, price-sensitive tenants will gravitate away from the higher-cost coastal locations.
So the IE supply shock pulls down rent prices across the entire region, even in the prime infill locations.
It acts as an economic gravity well, compressing rents everywhere. That supply shock is the engine driving that deflationary REXR data, and it's an immediate threat to PLD's domestic portfolio.
Okay, so the external environment is soft, regulatory risk is rising. Let's pivot to how management is responding. For the critical investor, capital allocation is everything.
And the old external growth model is defunct.
The easy money acquisition engine is broken.
Irrevocably. The math is relentless. Debt costs are around 6%. Acquisition cap rates are 4.5% to 5%. Any attempt to buy assets is immediately value destructive.
We see that in the peer data. Acquisition volume for companies like Rexford has dropped to almost zero in 2025.
You can't make accretive deals, so you have to pivot.
And that pivot is non-negotiable. Prologis has to shift focus from buying buildings to maximizing internal growth.
Which means disciplined capital recycling, optimizing their portfolio, and rigorously, and I mean rigorously, testing their development pipeline.
Development has always been their secret sauce. But even that is facing dangerous yield compression.
And this requires a serious risk premium test. We have to be skeptical of any developer, even Prologis, when we see this kind of data.
What's the data point?
Rexford reported stabilized yields on some repositioning projects of only 4.4% in Q3 2025.
Wait, hold on. 4.4% on a complex, risky development project when risk-free U.S. Treasuries are yielding 4.0%.
That's right.
That is an infinitesimal risk premium. It's basically nothing. It's a rounding error for taking on years of construction and lease-up risk.
It's unacceptable. It's a 40 basis point spread over the safest asset in the world. Prologis historically targeted spreads of 150 to 200 basis points above stabilized cap rates.
So if they're now accepting returns in the 4.4% range just to keep the machine running,
that is pure value-destructive empire building.
Logic says they should halt all new development starts and just return that capital to shareholders.
Absolutely. The critical investor has to scrutinize PLD's stated development yields very, very closely. Are they maintaining that historical spread, or are they hiding lower returns?
Speaking of returning capital, Rexford authorized a $500 million share buyback.
Right, at an implied cap rate of 5.8%.
Which is management signaling that their stock is cheap.
Unambiguously. Buying back stock is like acquiring their own real estate at a huge wholesale discount. A 5.8% cap rate with no transaction costs.
But for Prologis, buybacks are less accretive because of their premium valuation. Their implied cap rate is closer to 4.8%.
It's not as compelling.
So how does PLD deploy its massive balance sheet strength?
They prioritize funding that huge global development pipeline and their dividend, but their fortress balance sheet, with over $7.5 billion in liquidity, is their ultimate weapon.
Offensive and offensive?
It insulates them from rate shocks, and it positions them to capitalize on distress.
Like the yellow core terminals.
The perfect example. When a crisis creates a generational buying opportunity, Prologis is one of the very few players in the world with the immediate cash and credit to pounce. They are the buyer of last resort and first opportunity.
Okay, let's talk about the massive strategic pivot that could completely redefine this entire valuation story. The aggressive move into data centers.
This is the hidden asset value, the bifurcated outlook that might justify some of the premium.
They're becoming more than a logistics company.
They're becoming a logistics and energy company. And the key asset isn't the building. It's the power.
The secured power capacity.
Precisely. Power is the new constraint in real estate. And Prologis has secured an astounding 5.2 gigawatts of power capacity across key locations.
How much is that in context?
It's enough to power a small, developed European nation. It is a massive, durable new barrier to entry that no regional competitor can hope to match.
And they're channeling billions into converting their high-power land bank sites into data centers.
About $7 to $8 billion planned over the next 5 years.
So what's the takeaway for the investor here?
Data centers are expected to yield significantly higher margins than logistics, capitalizing on the AI build-out. The value of that secured power in that land bank, it's an unrecorded, highly valuable, intangible asset. If they execute this pivot successfully, the whole FFO growth story shifts back into the high single digits.
Which would justify a premium multiple.
It would.
Okay. We've covered the fundamentals, the risks, the moat, the pivots. Now we land on the central question. Is that 5-turn multiple premium 22 times PFFO justified?
We have to look at the valuation matrix. PLD is at 22 times, Rexford is at 17. Stag Industrial, another high-quality player, is below 17.
That translates to an implied cap rate for PLD of around 4.8 to 5.0%.
While REXR's portfolio is valued at an implied 5.8%, the market is actively paying a full 80 to 100 basis point premium for PLD's portfolio.
So for our critical value-focused investor, what exactly are they buying with that premium? What's the insurance policy?
You can break it into 3 core arguments. First, diversification as insurance. Prologis' global portfolio dilutes the pain from any one market, like the regulatory toxicity we see in California. Investors are paying for that geographic insurance.
Second, the A-rated balance sheet.
The scale and credit premium. In uncertain times, capital executes a flight to safety. Investors gravitate to the largest, most liquid name. Prologis commands a premium just for its financial stability.
And finally, the tech adjacency.
The data center optionality. The market is absolutely factoring in that 5.2 gigawatt power bank. They're treating Prologis partly as a next-gen tech infrastructure play, not just a cyclical landlord.
But here is the critical risk, and this is where you, the investor, must focus. At 22 times FFO, the stock is priced for perfection.
The math flaw here is the complete lack of a margin of safety.
Explain the math.
The 22x multiple implies an earnings yield of only about 4.5%. With risk-free, zero-risk U.S. Treasuries yielding 4.0%, you're getting a 50 basis point spread.
50 basis points to take on all the risks we've just discussed. The construction risk, regulatory friction, tenant credit risk, the freight recession.
It's barely enough to compensate you for owning a complex global real estate company instead of holding cash. That risk premium is statistically insignificant.
So for the price to hold, PLD needs what?
Not just stability. It needs consistent, high single-digit FFO growth, maybe 8% or higher, to bridge that valuation gap.
But what happens if the freight recession drags on?
Yeah.
Or if that rent deflation in Southern California spreads?
If the core growth component evaporates, the valuation simply cannot be sustained. If Prologis reverts to performing like a lower beta industrial REIT, focusing on dividends and slow growth,
it has to re-rate sharply.
If it re-rates to the high-quality peer multiple of 17 times, the implied downside risk to the stock price is over 20%.
Wow.
The critical takeaway on price is this. PLD is priced as a growth stock with the tech angle. If it reverts to acting like the slow-growth cyclical value stock it fundamentally is today, the multiple compression will be severe and painful for shareholders.
This has been a rigorous and I think appropriately skeptical deep dive. Let's bring it all home. What's the final verdict on the sovereign of the supply chain?
The final verdict acknowledges the complexity, the competitive advantages, the network effect, the data, the balance sheet. They are indisputably strong and durable. That ensures their long-term dominance.
What?
But the industry dynamics are currently negative to neutral. They're hampered by the freight recession and that acute rent deflation. And critically, the valuation is expensive. It offers no margin of safety for new capital.
So what's the recommendation for the prudent investor facing that tiny 50 basis point risk spread?
The recommendation is a hold for current shareholders, but absolutely avoid fresh capital commitment at this premium price.
It's a best-in-class company, but a poor investment at these levels.
Exactly. The prudent investor should wait for a better entry point, maybe closer to an 18 times multiple, or wait for clear, sustained evidence that the rent deflation cycle has passed and utilization is back above 90%.
To wrap, let's summarize the 4 key risks that any PLD holder needs to watch.
First, the higher for longer cap rate reset. If rates stay elevated, cap rates have to expand further, which means net asset value erosion.
The second.
Regulatory contagion. Watch to see if the WARE program, that tax on truck trips, spreads from California to other jurisdictions.
Third.
Tenant credit concentration. Consolidation is good, but a failure by just one of their top 5 tenants would have a material impact on FFO.
And finally,
supply overshoot. If those low development yields aren't enough to stop speculative building, we risk a prolonged period of oversupply that will keep pressure on rents globally.
those are the headwinds. But let's end with one powerful, counter-cyclical thought for you to mull over, the concept of geographic arbitrage.
This often gets missed in the macro analysis. It relates directly to the rising cost of labor.
So what?
Tenants like XPO are dealing with chronic driver shortages and massive wage inflation. A truck driver now costs upward of $60, $70 to $80 an hour.
Every minute that truck is on the road costs a fortune.
Especially the time spent driving away from the core distribution center, what they call STEM time. It's incredibly costly labor.
And Prologis' whole value proposition is owning the perfectly located modern facility that drastically reduces that STEM time.
Exactly. Look at the math from the tenant side. They're willing to pay an extra 50 cents per square foot in rent if the savings in driver wages and fuel exceed that cost.
So as labor costs rise,
The rent premium a tenant is willing to pay for that perfectly located Prologis asset also increases.
that is the genius of the structural advantage.
This trade-off between higher rent and lower operating expense is a powerful underlying counter-cyclical trend. It suggests that even as the economy slows, the intrinsic value of Prologis' best assets is structurally increasing.
That's the long-term buffer that will keep a floor under the stock, even if the valuation premium temporarily deflates.
That structural labor arbitrage, that's the true long-term moat.